Hello and welcome. In this lecture video, I'm going to be talking about a few transactions and then relating those transactions to the accounting equation. Remember, the accounting equation, as we see on this figure on page 11, is equal to assets equals liabilities plus equity, okay? So we look at our first transaction. Our owner, Chaz Taylor, has a sole proprietorship, okay? And he invests $30,000 cash to start a consulting business. So what's going on here, right? He's investing cash in his business. That is what is going on. And so when we think about what we do with accounting is we have to record this activity. This is an activity. This is an event. And part of accounting is that we have to record what happened. Okay. And so before we can even get to that point in terms of recording it, in terms of journal entries, which we'll talk about more in chapter 2, we first need to relate what's going on here to the accounting equation. So there's a few things that I want to underline. I'm going to underline this $30,000 cash, and I'm going to underline the word invest. Okay. So cash, that is a key word, and that's telling you, right? He's investing cash, and where do we put cash in terms of the accounting equation? That is an asset. Cash is an asset right there. And then invest, that's a key word. That's telling you owner investment, which we know is owner's capital. You know that from the prior lecture video. So in terms of what's going on with the accounting equation, my assets equals my liabilities plus equity. Liabilities are not being affected at all in this transaction. The only things that are being affected is assets because cash is going up. He's investing $30,000 cash in his business. The cash of the business is going up. Cash is an asset, therefore assets are increasing. Equity is also going up. Why is equity going up? It's going up because owner's capital is going up. Why is owner's capital going up? Because it says owner investment. Owner investment is owner capital. Okay, so owner's capital is increasing, and we know that from the prior lecture video that as owner's capital increases, equity also increases. So in terms of what's happening with this accounting equation, assets are going up because cash is an asset and cash is going up by $30,000. Liabilities are not being affected, but then equity also goes up by $30,000 because owner's capital in the form of owner investment also went up by $30,000. So assets go up by $30,000. Equity also goes up by $30,000, and we can see that on this figure here on page 12. Cash goes up, owner's equity goes up, cash $30,000, C. Taylor capital equity also plus $30,000. Transaction 2, purchase supplies for cash. So I'm putting my hand over this. I'm going to say Chaz Taylor's company, fast forward, purchases supplies paying $2,500 cash. So keyword, supplies, purchases, and then pays cash. Cash, where do we put that? That's an asset. Is cash going up or down? Cash is going down because I'm paying cash, so I have less cash. I purchase supplies. That means are supplies going up or down? Supplies are going up. Where do we put supplies in terms of the accounting equation? Supplies or assets. So what's going on with this is that the only thing that's being affected is assets. Liabilities and equity are not being affected in this transaction. One asset, supplies, is going up. The other asset, cash, is going down. Total assets stays the same, but the composition of the assets changes. I have $2,500 less cash, but I have $2,500 more supplies. So when we look at it right over here, cash goes up. I'm sorry, cash goes down. Jeez, I was looking at that first. As I said, cash goes down. by 2,500. Supplies goes up by 2,500. Total cash, total assets stay constant at $30,000. Total equity is not changed. Liabilities have no effect. Those stay constant at $30,000. When we look over here and we see how much cash we have, we initially started in transaction 1 with $30,000 cash. Here, we paid $2,500, so we have $27,500 worth of cash. We purchased $2,500 worth of supplies. Supplies are an asset, so now we have $2,500 worth of supplies. We take our cash of $27,500 plus our supplies of $2,500, and we're still at $30,000. It's just that the composition of our assets has changed. We have $2,500 less cash, $2,500 more supplies. Liabilities and equity are unchanged. Okay. Let's look at transaction 3, purchase equipment for cash. Fast forward, purchases equipment for $26,000 cash. This is the exact same thing pretty much as transaction 2. Because let's look at the keyword, $26,000 cash. We know cash is an asset. Is cash going up or down? It's going down, because I'm paying $26,000 cash. Okay. I purchase equipment. Where do I put equipment in terms of the accounting equation? Equipment is another asset, just like supplies. Okay. So equipment is going up $26,000. Cash is going down $26,000. The only thing that's being affected in terms of the accounting equation are assets. Liabilities and equity are not being affected by this transaction, only assets. Now, total assets stay the same at $30,000, as we see in this figure on page 13. Total assets stay the same at $30,000. Supplies stay constant at $2,500. Equipment is now $26,000. But now how much cash do we have? Well, after transaction 2, remember we had $27,500 in cash, and then we just spent another $26,000 in cash. That means we have $1,500 in cash left over. The $1,500 in cash plus the $2,500 of supplies plus the $26,000 of equipment gives us $30,000. This transaction did not affect liabilities or equity, because the only thing that we did is swap one asset for another. We purchased equipment with cash. Equipment is an asset. Equipment goes up. Cash is an asset. It goes down. Okay. Now, if you look over here, look at what we recorded it at, the cost. The equipment cost that we purchased is $26,000. We recorded it cost because of the cost principle. Okay. Let's look at transaction 4, purchase supplies on credit. Fast forward, purchase supplies on account. Okay. So whenever you see this on account or on credit, or on account, that means with the credit card. That means we're not paying for it now. We're going to pay later. It's on layaway. That's an old term for another way to purchase something on credit. Okay. Purchase it on layaway. Not sure how many companies still do that, but you could think of it as using your credit card. When you use your credit card to buy something, right, you're not paying right now. Do you owe the credit card company money? Yes, you do. You have a liability to that credit card company. Same thing here. Fast forward, purchase supplies of $7,100 on account. That term, on credit or on account, means they use the credit card. That means that they have a liability. So let's underline the keywords here. Purchases supplies. Where do we put supplies in terms of the accounting equation? It's an asset. Supplies are going up by $7,100. On account means I use the credit card. That means I have a liability. Okay. So when we look over here in terms of our accounting equation, what's being affected? Assets are going up by $7,100. Liabilities are going up by $7,100. Okay. So our assets now total $37,100. How'd I get that? The $1,500 in cash. And remember, I purchased $2,500 worth of supplies in a prior transaction. And then now I purchased another $7,100. That gives me $9,600 total supplies, plus my $26,000 of equipment. Means I have total assets equal to $37,100. That means the liabilities plus equity must also equal 37,100 because assets equals liabilities plus equity. So the accounting equation has to hold in balance. So that means liabilities plus equity equals 37,100. And we can go through and make sure that's true. Remember from transaction 1, Chaz Taylor invested $30,000 cash in his business. So equity in the form of owner's capital is $30,000. Now, we purchase supplies on account, $7,100. That is a liability. And the type of liability that's called is called accounts payable. Okay? So you have an accounts payable, which is a liability. So liabilities are now $7,100. The $30,000 equity plus the $7,100 liability gives us $37,100, which equals our total assets of $37,100. The accounting equation stays in balance and everyone is happy. Okay? Let's look at the next transaction. Provide services for cash. Okay, provide services for cash. So what this is saying is we provide consulting services receiving $4,200 cash, and I'm underlining that. So we can see right over here, we're getting cash. Where do we put cash in terms of the accounting equation? It's an asset. So I know assets are going up by $4,200. The total cash is going to go up by $4,200. I know that because it tells me that right there. Now, provides consulting services. Where do we put that in terms of the accounting equation? Well, that's revenue. We've earned revenue. We provide consulting services. We've made a sale. So we've earned revenue. And we can record that because we provide the services. We provided the services, which means we've earned the revenue. Okay? We've earned that revenue. So we have revenue. Now, where do we put revenue in terms of the accounting equation? Well, remember, revenue increases equity. So as revenue goes up, equity goes up. So in this case, what's going to happen is that assets are going up by $4,200. The left side of the accounting equation, the asset side, goes up by $4,200. The right side of the accounting equation, which is the liabilities plus equity, also has to go up by $4,200 because it has to stay in balance. But how do we know where does it go up? What goes up, liabilities or equity? Equity. Because revenues went up by $4,200 because we provided consulting services, that means revenue. Revenues go up by $4,200, which means equity goes up by $4,200. So on page 14, we can see that in our figure here. Our cash balance was equal to our $1,500 that we had in the prior transaction plus the $4,200. Right now we got paid cash. So now we have cash of $5,700. We still have supplies of $9,600. We still have equipment of $26,000. That means we have total assets equal to $41,300. Our liabilities are the same at $7,100, but now our equity is higher. Our total equity is $34,200. How did I get that? Well, remember transaction 1, Chaz Taylor invested $30,000 in his business, owner capital, and then we made a sale, $4,200. So we add that $30,000 plus the $4,200, $34,200. We add that to the $7,100. Our liabilities plus our equity now equal the same as our assets at $41,300. Okay? Let's look at transactions 6 and 7. Company pays $1,000 rent and $700 salary. So you can see pays rent and pays salary. That means cash. What do we pay it with? Cash. So cash is going down by $1,700. Cash is going down by $1,700. Where do we put cash in terms of the accounting equation? It's an asset. So assets are going to go down by $1,700. Rent and salary. You have to pay rent and you have to pay salaries for your employees. Why? Those are costs of doing business. Those are expenses. And what do we know? Expenses decrease equity. So our expenses, as they go up, equity goes down. So what's going to happen over here is our cash goes down by $1,700, $4,000, $9,600 supplies, $26,000 equipment, total assets $39,600, accounts payable is the same, and then what we have is our revenues minus our expenses,